The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome, everybody, to this week's episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that feds need to know in 15 minutes or less. So whether you are a seasoned federal employee or whether you're just starting out in your career, Fed15 has got you covered. So grab your coffee, kick back, and we will tell you what you need to know but might have missed in the federal news space this week. We're your hosts. I am Katelyn Murray, and as you can see, this week we are joined by a fresh face that is new to the podcast, but certainly not new to Serving Those Who Serve, the wonderful, magnanimous Mrs. Jen Meyer. Jen, how are you?
I'm great. Thanks, Katelyn. Really super excited to be here. My first podcast ever. So yeah, super excited. I'm jazzed.
Awesome. Well, we're so thrilled to have you here. I know last week we had Chelsea filling in for me. We really want to try to give our audience a sense of, peel back the curtain a little bit and meet some of the faces here at Serving Those Who Serve. And luckily, our team is really enthusiastic and very, some of them are quite interested in helping out with the podcast. So over the next coming weeks, we hope to maybe introduce some new faces to you, Jen, of course, being one of them. So Jen, just to tell you a little bit about her, she brings almost 30 years of experience in the financial services industry to our firm. She's been with us for about 6.5 years now. That's why I say she may be new to the podcast, but she's definitely not new to Serving Those Who Serve or really to the federal financial advising space. So Jen, if you are an ardent reader of our blog and the weekly serving, you will recognize her name, I'm sure, from countless articles. We've certainly covered articles that she's written here on the podcast before. So we're really thrilled to kind of expose the man, or I guess in this case, the woman behind the curtain there. So.
Yeah, definitely. Again, I love working with feds. So this is a new thing for me. I can remember a couple of years ago when we started doing webinars and, I had never hosted a webinar before. So it's a great opportunity. And I really love that you've helped us get this podcast and, so thanks for having me.
Oh my God. Oh, well. No problem. It's really kind of interesting. I think as much as, nobody liked going through the panini, right? I'm going to use a different word because we do put our podcasts out on YouTube and I don't want to be, pushed down in the algorithm. YouTube doesn't like certain words. But I think, what everybody went through in 2020, right, definitely was a catalyst, I think, for exploring different ways that we could reach out to feds, different ways that we could connect with people. And certainly kudos to Dan and really to the whole Serving Those Who Serve team for really meeting that challenge, I think, head on and really looking at something that could be perceived as a challenge or an obstacle and really kind of flipping that, reframing it and turning it into an opportunity to explore different mediums and modes for helping feds, which is what we're all about. So
yeah.
Awesome. Well, super, super glad to have you, Jen. And I hear that you are coming to us today with some information on one of many important federal benefits, which is the FERS Survivor Annuity Supplement. So tell us a little bit about that FERS Survivor Annuity Supplement.
Yeah, so definitely. And, I think one of the unfortunate realities of working in this industry is that sometimes we have to help people navigate the death of a spouse, right? And in the federal space, for sure, there are a lot of benefits for surviving spouses. And Some of them are more well-known, and this one in particular, I think, is not very well-known, and it's called the FERS Survivor Annuity Supplement. And so this particular benefit is designed only for surviving spouses under the age of 60, right? So that's kind of rule number one, if you will. And it is based on their deceased spouse's years of employment. The other parameters, if you will, for getting this benefit is that, first of all, you have to not be getting Social Security disability, and you also cannot be eligible for any parental benefits as a surviving spouse. And again, that's based on Social Security. Now, when somebody is receiving that FERS survivor annuity, that's when they're eligible for this. And really, the survivor annuity supplement is designed to provide income until the surviving spouse is eligible for the Social Security benefit at age 60, right? And so that's kind of the general framework for it, if you will. Couple things, and some of our viewers or listeners might be familiar with the FERS supplement that applies to retirement, where if somebody retires under FERS, they get a supplement if they're under age 62 and they have a certain number of years of service, so on and so forth. Well, this is a similar type of supplement, but one of the big differences is that this supplement is not subject to an earnings test. And so, many surviving spouses, of course, end up having to work, even if they weren't working before. And there's no earnings test that applies to this. And then the other feature, if you will, is that you will get a cost of living adjustment on this survivor annuity supplement. And you don't get that under the FERS retirement supplement. So those are, again, there's some nuances to it, but it is a survivor benefit that FERS surviving spouses are entitled to. And they are entitled to it even if they don't take Social Security survivor benefits at age 60. So, those are some of the parameters around it.
Gotcha. Yeah, no, I definitely think, and we always kind of encourage, the pieces that we cover here on Fed15 are typically articles that are written and published there on our blog at STWServe.com. So if this is something that you think could apply to you, if this is something that you're interested in learning about, I would definitely encourage folks to check out the article there. Sometimes it's helpful to hear it. Sometimes it's also helpful to see it and kind of read through. I think, there's some sort of quote, Dan probably would know it, but there's some sort of quote about, I think you need to hear something on average like 7 times before it sinks in. I forget the number of times. It's way higher than you think it would be, but definitely encourage folks to go check out the article there if that's a benefit that you're less familiar with. Always good to kind of be in the know about those sorts of things. While we're kind of on the topic of survivor benefits, those sorts of things, we had another great article come out this week on the top 5 mistakes that feds make when it comes to life insurance. So obviously here at Serving Those Who Serve, we do a lot of great financial planning work. We do a lot of investment management for clients, but the way that we approach our relationships with our clients is very much comprehensive. So we also talk life insurance with a lot of feds. In fact, after our recording session today, I've got a meeting to talk with a client about life insurance coverage and just kind of evaluating and navigating how much coverage do I need to have? How long do we need to carry this coverage? The different seasons of your life, what the amount of coverage that you need could be very different, particularly if you're getting into that era. If you've got kids, if your kids are in college, if they're coming up close on graduation, if you've got kids who are maybe in their late teens, early 20s, maybe you're, getting into your 50s, 60s, and you're approaching that retirement time horizon, it can be a little difficult, I think, to navigate how much coverage you actually need life insurance wise. And so this article that we put out this week was really interesting, kind of going through, the top missteps that we see working with thousands of feds across the country when it comes to life insurance specifically. So the number one issue is mismanaging beneficiary information. I know Dan and I have said it on the podcast a million times. We will probably say it a million more. Please, 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 please check your beneficiary information regularly. You want to make sure you hear horror stories Personally, I've never had an experience like, finding out that somebody didn't update a beneficiary, but, you need to make sure that you're checking TSP beneficiaries, life insurance beneficiaries, all of that at least once a year, just to make sure that you're on top of it. But other things that you need to do, we need to differentiate between an estate and a trust. A trust is totally different than an estate. Making a trust as a beneficiary can be a good thing. It can be helpful, especially if you've got a blended family or if you've got a couple different kids and grandkids that you're looking to kind of split assets between. Making your estate a beneficiary, a little bit more problematic. I think a lot of folks are like, oh, I'll just list it as my estate and then my will can take care of it. It can lead to probate. It can lead to unnecessary taxes in certain situations. So you want to make sure that you're clear on your beneficiary designation strategy. Also, another mistake that we see commonly, folks misunderstanding the different types of life insurance. So 2 main categories, just as your quick flyover, you've got term life insurance and then permanent life insurance. A common mistake that we'll see is folks will own one type of life insurance when really something else would be more suitable. So if you are in a situation where you've got, kids that are maybe like 10 and 15, and you really the period for which you need life insurance because maybe you're a Fed, your spouse has access to survivor benefits on your pension, those sorts of things. You've got an investment portfolio. Really, your spouse is probably going to be okay if something happens to you. But those kids, we need to make sure that we get them through college and kind of on their own. So in that situation, you could consider something like a term life insurance policy. But oftentimes we'll see people taking out whole life policies, permanent life insurance, where they're paying much higher premiums when really a term life policy would be much more suitable. And with term life, you can kind of set the period of years that you need. So again, with a 10-year-old, pick up a 10-year term life policy that's going to take you through, that 10-year-old turning 20, hopefully being, most of the way out of college at that point. And that would certainly be probably more appropriate given those parameters. Another mistake that we see, all life insurance being owned by one spouse. We want to be mindful of the gross estate limit, the cap on the estate tax exception. Currently, it's sitting at $11.58 million, but that could change in the future. There's also state limits on how large your estate can be before you're looking at 40% state tax. So you want to kind of be mindful of who's owning the insurance, how much we kind of have that's part of that's on that one spouse, and see if there's maybe a more equitable way to manage that. This next one, I can almost hear Jen groaning now, not realizing that FEGLI gets more expensive over time. It progressively those premiums progressively grow over time, especially after the age of 59. After 59, premiums for FEGLI get more expensive each year. And if you're in a situation where you may need life insurance coverage for a portion of your retirement years, you may want to look into private individual term life policies because that could be a better bet. Really, when you're looking at FEGLI, remember FEGLI is a group life insurance plan. There's no healthcare screening associated with it. So if you are kind of on the healthier side, going through a private life insurance company where you do have to submit to a healthcare screening could result in a better premium. Because if you think about, a big pool of people, there's no healthcare screening. You're going to have people who are on the super healthy side of things. You're going to have people who are on the super not healthy side of things. And when they set the premiums for these group term policies like FEGLI, they're kind of averaging all of that together. So if you are reasonably healthy, you could look at private individual term life insurance to get a better premium if you're looking at carrying life insurance past 59. This is especially important for option B. You do have some wiggle room when it comes to FEGLI Basic and option A. We've talked about this on the podcast before. With Basic and option A, you can opt in for a 75% reduction, at which point the premiums become free. There is also a 50% reduction option for FEGLI Basic and option A that allows you to keep a little bit more of your base benefit just for a reduced premium. So premium wouldn't be free with the 50% reduction, but you would be able to pay a reduced premium and kind of help manage those costs a bit better. So some options there, but definitely understand that FEGLI is certainly by no means the cheapest life insurance coverage that you can get out there for most folks, at least.
The one thing that I find all the time, and literally the meeting I had this morning, somebody had no idea about 75% reduction as an option, and people drop their life insurance before they retire because they know it gets expensive. Well, I guess if they know it gets expensive, they just drop it, and they don't recognize that benefit. So
absolutely. Yeah. Take free money that's on the table. And if you're listening to this podcast episode and you're thinking 75% reduction, 50% reduction, we're getting into that like Zach Galifianakis meme with all of the like math equations around him and you're feeling lost. If that is you, please reach out to us at askstws@stwserve.com, and we'd be happy to kind of explain those different FEGLI reduction options to you, because we certainly, one thing we hate to see, Jen and myself and the rest of the Serving Those Who Serve team, is feds leaving free money on the table. So definitely reach out to us. We'd be happy to have a conversation with you about the options there. And then the last mistake that I just want to briefly mention, I know we've talked about this on the podcast before, it's been a while, rushing into a pension max strategy. So in short, pension maximization is a strategy where you're using a private life insurance policy to supplement or substitute the FERS or CSRS survivor benefits. You do have to have spousal consent for this. And you need to understand the advantages and disadvantages of this kind of strategy before you move forward with this. It's a little bit too complicated to get into on a 15-minute-ish episode today. If this is something that you're considering and you're not 100% clear of pros and cons on it, I do encourage you to reach out at askstws@stwserve.com so that we can have a more detailed conversation about it. But, there are some pretty significant drawbacks to this kind of strategy. One being that the surviving spouse would be ineligible for FEHB healthcare coverage. That is a big, big, big benefit for our feds. If you're looking at a pension max strategy, you're not going to be able to carry that coverage, which is significant. So it's one of those measure 3 times, cut once type of deals on that kind of strategy there. So awesome. Well, I think that is all that we've got on our docket today, Jen. You made it through your first podcast episode.
Yay! Yeah, the first one's the hardest, right? They only get easier. So, But yeah,
absolutely.
Thank you very, very much. So I guess I'll just do a quick little wrap here. So I thank you, everybody, for listening and watching. And I know Katelyn will be back next week with other members of our team. So hopefully I'll be back too sometime in the next couple of weeks. So
absolutely. And be sure, so that you don't miss another Jen episode or a Chelsea episode or even the regular schmegular white bread Dan and Katelyn episodes, be sure to subscribe to the podcast on the YouTube channel so that you never miss an episode. We are also on Spotify if you're an audio only type of person. And please, please, please remember to share with your friends and colleagues. It's free and it really helps us spread the word and really further the conversation around federal benefits.
For more information on the topics covered in today's show and more, be sure to check out our blog at blog.stwserve.com. Subscribe to our newsletter, The Weekly Serving, to get all the latest news for feds delivered right to your inbox every week.
Absolutely. And for those who want to dive even deeper into learning about your federal benefits and financial planning for feds, we encourage you to join us for one of our complimentary webinars. We actually have a FERS webinar coming up on July 9th. It's a little ways out, so maybe mark your calendar for that, but it'll be July 9th from 11 a.m. to 2 p.m. And since we talked about FEGLI in today's episode, our next FEGLI webinar is coming up on July 16th from 11 a.m. to 2 p.m. Of course, if you prefer a one-on-one approach, go ahead and reach out to our team. The email again is askstws@stwserve.com.
Awesome. So thanks for listening to the Fed15. I'm Jen Meyer.
And I'm Katelyn Murray.
And we'll see you next week.
See ya. Be well, everybody.
Bye.